Okay, I think we're cooking with gas. Sorry about that. We have just been waiting a little bit of time for that, so apologies for a few technical issues coming through. I'm just going to move my camera down a little bit. Right, I really apologise for that. We had some teething issues within the YouTube backend, which we hadn't quite worked out. So hopefully that's all good to go. You can see me clearly. Looks like you can. Thank you very much for hanging around. Those people that have waited a couple of minutes, we obviously apologise for that. Okay, so we're looking at all the things in the gold market today. If you've ever got any questions, then obviously do feel free to write them into the questions panel. I'm going to have a look at not just the technical side of things, where the balance of risks lies, but we're going to go into a couple of other aspects as well. Some like positioning. We're going to look at the options market to understand what the market's implying in terms of movement going forward, and we can use that to understand how the market perceives risks in the gold market and other markets as well. So let's dive straight to it, because what we're looking at very closely, is what's happening next week, because next week's the big one. Let's go into the bond market to start with. I'm going to go straight into the bond market, because rather than having a look at gold, we've got to have a look at this situation in 10-year treasuries. These are nominal treasuries. We're just holding a range of 137 down in 121. Now, why is that important? That is important because next week we get the Fed meeting coming out on Thursday at 4 o'clock. Jerome Powell will speak at 4:30. He has made it very clear that he's trying to separate this linkage between tapering and when the Fed start to hike. They've got no real reason to be any reason to be hawkish, should we say, given everything that we're seeing in the softness in Q3. But we do expect them to open the door to tapering probably in November, if not December. We saw a Wall Street Journal article pretty much letting the cat out of the bag on that one recently. So that's something to keep in mind. Let's have a look at what the market's implying now. The market has no idea really what to do. And what you see in this US Treasury situation is very much something that we're seeing in 10-year treasuries. Now, sorry, I think I've just been showing out without actually showing the charts. Have a look here at real rates that you can see in US 10-year treasuries now. You've basically got stuck between -1% and -1.1%. As we go into the Fed meeting, and depending on what the Fed say, and direction that inflation-adjusted treasury yields go, well, I think will probably dictate where gold prices are going to go going forward. So as you can see there, if we get a more hawkish shift and nominal treasuries move up faster than inflation expectations, I would imagine that real rates are going to go up. Test this 200-day moving average at -92. What we tend to see in gold is if real rates, inflation-adjusted returns in the bond market become less negative, it actually takes a lot of the impetus to need to buy gold as a hedge in your portfolio. Even though you've still got deeply negative real returns in the treasury market, they are lower, and therefore that becomes a headwind for gold. If we do see real rates breaking through the bottom end of this range and looking like it's going to test -120 again, then I would imagine gold prices will probably move a little bit higher. So we are watching this very closely. I've got it on trading view at the moment. You can see nominal treasuries, so this is not inflation adjusted. Again, we come into this range that you can see 137 down to 127. This might be another one there. If treasuries break out to the upside, we see sellers playing through. You can trade this. You can have a look on trading view, or you can go into the ETF language and have a look at the IEF or the TLT as a good one to look at for clients who are trading with Pepperstone. You can see that on the MT5 platform. You can see those ETFs which mirror and track the 7 to 10 year duration, or the longer term one, which is the TLT. But for me, I think gold markets and gold traders who are not scalping in and out of bars, 5-minute bars, 15-minute bars, but for people who are taking a slightly longer term view, taking maybe hours, 4 hours to daily charts, I think this is going to be what you absolutely have to look at. So you're looking for a break either side of that, and that will dictate where the gold price is going. Now let's actually have a look at the gold price, because what we're seeing here, again, what we've just seen in that range that we've been seeing in 10-year treasuries and 5-year treasuries, if we go into the sort of belly of the curve as well, is we can see that move in gold is exactly as we planned last week. We were looking to range trade the gold price, and that's exactly what we're seeing here as well. What we're seeing in treasuries and that range that we're seeing there is reverberating in the gold market. It needs a spark. It needs a catalyst. Now, does that come from the Fed meeting next week? We'll have to see. But what we can see is the last 7 days, the gold price has done absolutely nothing. We had a bullish engulfing coming through, on the 14th, off this support zone that we've been seeing here around 1790. And that's quite telling though. So again, we've got this on our radar. We've got this sort of brown support zone, or the yellowy brown goldy kind of support zone that you can see into sort of 1776. That's really key. We can see so many times whenever the gold price comes into here, the buyers step back in. We saw an engulfing coming through on that day. We didn't see the follow through. We were hoping for the bulls were hoping for the follow through. Didn't. We saw a lower high and markets traded back down to about 50% of that range. Obviously, we've got a bit of indecision playing through today, but the gold market has absolutely no idea where it wants to go at the moment. This, again, it just tells me that right here, right now, up until the Fed meeting, that range trading this is the right way to go. It's not trending. You can see the RSI is at 50. It's at mid-range. This is a perfect range trader's paradise. So where do we look at? We look at the options market. And again, I come back to my friend, the weekly straddle. So for people out there who are unfamiliar with volatility strategies that you can see in the options market, have a look at straddle pricings. They're a way of buying and selling volatility. Most people sell volatility, but what they do is they give us an understanding about the expected movement up or down in any asset over a specific time period. And what I'm looking therefore to understand is the straddle pricing, what the market's expecting for movement over the coming 5 days, which encompasses the Fed meeting, up or down. And we can use that then, because if the market's implying that, and we know there's a lot of hedging flows around that, then we can use that to map out an expected movement in the gold price over a period with a level of certainty, or a level of confidence, should I say. So again, if I look at the straddle pricing at the moment, it gives us a move up into 1816 down to 1765. This over the coming certainly for tomorrow and early next week, will be the levels that I'll be looking to fade it into. Again, if we get a move up into 1817, I would probably be very happy, given the price, to leave limit orders there and see how price reacts if we get a situation there where the market sells into it. I think there's a pretty good chance the price is going to be contained there. The market's putting about a 70% level of confidence there. So if we get moves up into this 1819 level, I think that would probably be an opportunity to look for short-term, short opportunities in gold. On the other side, if we get a move back down into these levels, 1766, there's about a 70% chance that we're going to see price contained within that level as well. Obviously, the gold bulls out there, and I know there's a lot of them in this room, everyone loves a bit of gold, is looking for this big level up here, 1733. You can see just how important that is. It's been capping the moves for the last couple of months. If we can get a move up there, and I don't get my opportunity to have a bit of a mean reversion play, we'll obviously see how price reacts into 1833. And if we can get a close above that, then I'm going to turn outrageously bullish on gold, because I think that is so significant for the gold market. For me at the moment, everything is telling me that gold is a mean reversion play. Let's have a look at what happens in real rates. Let's have a look at what happens in nominal treasuries. If yields go higher, gold's going to trade down to the bottom of this range, and we'll have to see how price reacts in there. What we can also do is, just to give us a bit of credence around that mean reversion trade that we're looking to trade that range, is put a Bollinger Band on there. Why do I like Bollinger Bands? Bollinger Bands, obviously, if you're taking a 20-day moving average, it trades one or two, in this case, 2 standard deviations. And 2 standard deviations, as we know in statistics, in a range trading market, captures 95% of outcomes in a normal distribution. So we're just giving ourselves just that level of credence. We're looking at a situation where the options market is telling us the expected or the implied move, so it's more forward looking. It takes an element of realized volatility in there and it projects it forward. And then what we can also see is the Bollinger Bands using a situation of realized volatility or movement from that mean. And again, that should just give us that idea that any kind of moves up into this, above this level here, probably represent a good level to mean revert in that situation. So everything at the moment is continuing to trade that range. And that's the way that I like it. I know there's people out there going, oh, Chris, when are we going to get a trend? Well, we may get a trend, but let's have a look at that. This is my implied volatility band. I'm not going to go into too much about that. Okay, so let's have a look at the market and how it's set up over the next 5 days. Again, I really love looking at the options market, because it really just tells me so much about semantics, and it tells me so much about how people are positioned. And this one is a chart of skew. And what we're looking at is the implied volatility in 1 week gold. The top one is 1 month. So we're looking at gold 1 month put volatility minus 1 month call volatility. And you can see that puts are trading at a premium of about 0.24 of a volatility. And you can see on 3 month, you can see a situation where calls are trading at a slight premium to puts. I'm more interested in the short-term situation. I really should have a 1 week volatility measure there. But what you can see here is that 1 month put volatility is trading at a slight premium to calls. It's not extreme by any means at all. I like to see when it gets down to about the sort of 3 standard deviation mark, that's when we know that the market has really hedged itself for downside in the gold, and that can be quite a big contrarian indicator in itself. They are lower, but you're trading about 1 standard deviation to this 5-year average, but it's not extreme by any means whatsoever. So again, if you look at semantics, we can see that people have been better buyers of puts rather than calls, which gives you a right to downside, but it's not at any kind of extremities at all. In terms of positioning, I'll look at the weekly CFTC report, looking at managed money. You can see 83,000 net long contracts, not extreme. It's slightly lower from last week, where we saw about 100,000 net long contracts. These are in futures and options, so I've combined them together. It gives us a sense of what the managed money are doing in terms of gold at the moment. So the market's long, but it's not particularly long. Our clients are generally long of gold. About 60% of open positions are held long at the moment, but they can be a blend of really short-termism to slightly longer term. In terms of the range, what we've been seeing again, the range is sort of falling away. If you look at the high-low range and you look at the 5-day average playing through here as well. So that's quite an interesting one. I like to look at that because we're enclosed in the whole move in gold. We've seen a couple of big moves over the last few days, but nothing substantially. Generally, gold, as you can see here, this is the 1 week implied volatility, this bottom line here. And you can see that we've actually seen a slight pickup in implied volatility. And I think that's probably because we're starting to, that 1 week is now including the Fed meeting next week. So when I look at what the market's pricing in terms of movement in gold for next week's, including up until next week's Fed meeting, 12.75%, that's an annualized standard deviation number. And it's really not telling me that the market's expecting major moves in gold. If we were up at sort of 16-17%, then I would say, that we're starting to be a bit concerned about the movement that we're going to see in rates, the movement we're going to see in the dollar, and then subsequently the move in gold as well. But at this point at the moment, the market's quite subdued. And you can see here is my forward implied volatility bands that I like to use, which you can't actually get anywhere else. It's something that I've made. Okay, so just bringing this back to the gold chart again. It's an interesting one. I still like the range trade on gold, but if we have a look at where people are really trading this at the moment, for the moment it's difficult because so much attention is being put on the crude market. You can see here the US crude market's having a lovely move up. Energy is just the trade du jour at the moment. We've got this beautiful double top. I really should have it on a weekly chart. But you can see this massive double top in the crude price into 76, into the high 76s. What's that? About 77 bucks. Yeah, 76.95. Can we push back into those levels? I wrote an article on the website about that today. It's interesting. There's real momentum behind this at the moment. Obviously, supply has been coming out. We saw that in the weekly inventory numbers coming out last night in the US. I think if crude prices keep pushing up, that could take some wind out of the gold prices sales. And I think if you're looking in copper, not looking overly great. If you have a look at the crypto scene, is there money coming out of gold for crypto? It's a difficult one to judge, but you can see there's a nice short-term trend coming back into crypto. That's Ethereum. You can see a nice short-term trend again in Bitcoin. We've broken through the 20-day moving average, the mid-range of the Bollinger Band there as well. Can we creep back up into 52,000? Obviously, that's something that we're going to be seeing. If that FOMO kicks in, that may take a little bit of money out of the gold price. I'm not so sure. Again, we come back to our friend, the 10-year Treasury. This is really going to guide me this week as we go into the retail sales numbers tonight, as we go into the Fed meeting next week. This is trading a range. And as long as the 10-year Treasury, real and nominal, is trading a range, the gold price will continue to hold that range that I talked about, and I want to continue to trade that in the short term. If this breaks out and the rate of change picks up, that volatility in the gold price will pick up. We'll see the ranges pick up. That will mean that will have big implications for your position sizing when you're trading gold and the hold periods and the liquidity in the gold price itself. So again, this is guiding my world at the moment when it comes to gold. As long as this is moving sideways and contained in this range, my trade in the short term continues to be to want to hold and look to fade moves above 18.17 and really down into 17.65. So that's the playbook for the week. Personally, I would love to see a situation where we break out of the range and we start trending, we start making higher highs and higher lows, or lower lows and lower highs. I prefer trading ranges. I think that's where it gets a bit more exciting and you can catch swings within that. But we have to trade the market conditions we're in. And if the 10 year is moving sideways, the volatility is fairly low, and the price action that we're seeing is fairly well contained, then you've got to go along with that and trade as you see fit at the moment. Unfortunately for the gold bulls out there, for me it's still a range trader's paradise, and all signs are that we want to continue to respect those ranges there as well. So if you've got any questions, obviously leave them, or if you reach out to the team at Pepperstone or reach out to me on Twitter, @ChrisWeston_PS, then obviously you can get to that. And obviously, next week as well, I think it's an interesting one. We actually will be doing a live event, which is going to start doing a lot more work around algorithmic trading. So we're going to be starting a series of interviews. So I won't be back at 3 o'clock next week. I will do a recorded version of this. But if you want to tune into, and if you're into algorithmic trading and systematic trading and using expert advisors, then feel free to tune in. You'll be able to find all the information on our website around that as well. But for now, you're trading the range, and if you've got any questions, do reach out. If you found yourself liking this, do click on the like button. For now, it's a range trader's paradise. I'll see you guys soon. Thanks.